Picture this. It is 3 a.m. in the financial district. The algorithms are running silent, and suddenly, liquidity evaporates. In the last 30 days alone, gold dropped nearly 9%. Silver crashed over 26%. And a major private credit fund, managed by the largest asset manager on Earth, quietly lost 19% of its value in just one single quarter. These are not random events. They are not glitches. They are connected fractures in the global financial architecture. Welcome to the briefing. I am speaking to the silent observers, the few of you who value raw data over the noise of mainstream media. What we are witnessing is the disconnect between the paper price of assets and the physical reality of wealth. The machine is shaking. The gears are grinding. And the average investor is walking blindfolded into a buzzsaw. Before we dissect the anatomy of this crash, I need you to focus. Tell me in the comments below, where are you observing this market collapse from? Are you in New York, Singapore, or perhaps watching the charts from Sydney? Lock in your location. Now, let us look at the evidence. Let us dismantle the machinery. To understand why silver crashed 26% while physical demand remained near all-time highs, we must look at the Chicago Mercantile Exchange, the CME. This is the nerve center where the paper price of gold and silver is determined. It is not determined by how much metal you can hold in your hand. It is determined by how much leverage the big banks are willing to extend. When the price of silver begins to rise, threatening the short positions of the bullion banks, the exchange has a weapon. It is called the margin requirement. Imagine you are trading with a leverage ratio of 20-1. For every $1 you put down, you control $20 of silver. It sounds powerful until the exchange raises the margin requirement by just 2%. That 2% increase does not mean you need 2% more cash. It means your capital requirement has just doubled. You need 40% more liquidity immediately. If you do not have it, the computer automatically liquidates your position. You are forced to sell. This is not a market correction. This is a forced liquidation event. It is a feature, not a bug. But the rabbit hole goes deeper. While retail investors panic sell their paper silver, the smart money is moving. We are seeing a massive rotation out of paper assets and into something far more dangerous, private credit. This is the shadow banking system. It is a $1.7 trillion market of loans made by non-banks, by hedge funds, and private equity firms. It is opaque, it is unregulated, and it is the new subprime. Remember 2008? The banks were too big to fail. Today, the risk has moved. Banks lend to hedge funds. Hedge funds lend to zombie companies. When those companies default, the hedge fund collapses. When the hedge fund collapses, the bank is left holding the bag. We just saw a major private credit fund managed by BlackRock lose nearly 1/5 of its value in 90 days. That is a tremor before the earthquake. And here's the terrifying part. The mechanism for the next bailout is already in place. It is not a bailout, it is a bail-in. Under the Dodd-Frank Act and similar regulations in Europe, when a bank fails, they do not need taxpayer money anymore. They can legally confiscate the deposits of their unsecured creditors. That includes you. Your savings account is technically an unsecured loan to the bank. In a systemic failure, that loan can be converted into equity. You wake up on a Tuesday morning and your cash is gone, replaced by shares in a bankrupt institution. This happened in Cyprus. It can happen here. The legal framework is signed, sealed, and waiting for the trigger. This brings us to the ultimate control grid, the central bank digital currency, or CBDC. This is the third tier of the confiscation playbook. Tier 1 was Executive Order 6102 in 1933, the physical seizure of gold. Tier 2 is the current system of stealth inflation and negative real rates. Tier 3 is total programmable control. Imagine a world where you try to sell your gold for currency, but there is no cash. There is only the digital dollar. You sell your ounce of gold. The transaction is flagged. The central bank's algorithm decides that this transaction does not align with their current monetary policy or carbon footprint goals. They can freeze the funds instantly. They can apply a negative interest rate of 5% per month to force you to spend. They can set an expiration date on your money. This is not science fiction. The technology is being piloted right now in major economies. The crash in silver we just witnessed? It is a distraction. It is designed to shake out the weak hands before the real repricing occurs. The bullion banks are net short on paper, but they are accumulating physical metal. They are driving the price down to cover their shorts and load up on physical bars at a discount. It is the classic rinse and repeat cycle. They smash the price on the paper market, trigger your stop losses, and then buy the physical metal you just panic sold. We are seeing backwardation in the silver market. This is a rare anomaly where the spot price of silver is higher than the futures price. In a normal market, futures should be more expensive due to storage and insurance costs. When the spot price is higher, it screams one thing: physical shortage. The industry needs silver now. They do not want a paper promise of silver in 3 months. They need the metal for solar panels, for electric vehicles, for cruise missiles, and they are willing to pay a premium to get it. Yet, the price on your screen says silver is down. This divergence between price and value is the opportunity. It is the point of maximum financial asymmetry. But to seize it, you must ignore the red candles on the chart and look at the draining vaults. The COMEX, registered silver inventory, the silver that is actually available for delivery, has plummeted. It is down nearly 70% from its highs. The vaults are bleeding. The system is fragile. The leverage is extreme, and the exits are being bricked up one by one. The private credit crisis is the fuse. The derivatives market is the bomb, and your deposits are the collateral. This is the anatomy of the trap. They want you in paper assets. They want you in unallocated accounts. They want you in the digital system, where you can be tracked, taxed, and turned off. But there is an exit. There is a way to step outside the blast radius. It requires understanding the difference between currency and money. Currency is a claim on the government. Money is a store of value that requires no counterparty. Gold and silver are the only financial assets that are not simultaneously someone else's liability. We are now moving into the historical context. To understand where we are going, we must look at the last time the world faced a sovereign debt crisis of this magnitude. We must look at the 1970s. We must look at the Hunt brothers. And we must look at the end of the Weimar Republic. Because history does not repeat, but it rhymes with a terrifying precision. The setup is complete. The liquidity has been drained. The trap has been set. Now, we watch the dominoes fall. To understand the mechanics of the next crash, we must autopsy the corpses of the past. The financial markets have a very short memory, but the algorithms that run them are programmed on history. Specifically, we need to look at the year 1980. This was the year two Texas oil tycoons, Nelson Bunker Hunt and William Herbert Hunt, decided that the dollar was dying. They were right about the dollar, but they were wrong about the casino. The Hunt brothers did not trust paper money. They began accumulating silver. Not futures contracts, not paper promises, but physical bullion. They took delivery. They moved the metal onto planes and flew it to Switzerland. They created a shortage so severe that the price of silver skyrocketed from $6 an ounce to nearly $50 an ounce. The panic in the halls of the regulators was palpable. The Hunts were on the verge of breaking the banking system because the banks were short silver, and the Hunts were squeezing them into oblivion. So, what happened? Did the free market resolve the price? Did the laws of supply and demand function as they are taught in economics textbooks? No. The establishment changed the rules. On January 21st, 1980, the COMEX Board of Directors, which was composed largely of the very bankers who were losing money to the Hunts, invoked a rule change. It was called liquidation only. It meant that traders could no longer buy new silver positions. They could only sell what they already had. Imagine playing a game of poker where, just as you are about to win the pot, the house declares that you are only allowed to fold. The buying pressure vanished instantly. The price collapsed. The Hunts were bankrupted. The banks were saved. The lesson here is brutal and absolute. If you play in their casino and you start to win too much, they will flip the table. Fast forward to 2008. We saw the same pattern, but with a different trigger. When the housing bubble burst and Lehman Brothers collapsed, silver plummeted from $21 down to $9. Why? Because in a liquidity crisis, investors sell everything that is not nailed down to cover their margin calls. They sold gold, they sold silver, they sold stocks. Cash was king for about 6 months. But then, the printing press started. The Federal Reserve unleashed quantitative easing one. They flooded the system with new currency. And what did silver do? It did not just recover. It exploded. From the low of $9 in 2008, it ran all the way back up to nearly $50 in 2011. It was a 500% move in 3 years. Why does this matter now? Because we are seeing the exact same setup in the charts, but the scale is exponentially larger. The debt today is $36 trillion, not $9 trillion like it was back then. The leverage is higher. The derivatives are more complex. But there is one critical variable that makes this time fundamentally different from 1980 or 2011. This time, the entity squeezing the market is not two brothers from Texas. It is not a hedge fund. It is the entire Eastern Hemisphere. We are witnessing a historic geopolitical pivot. For decades, the price of gold and silver was set in London and New York. It was a Western game, but the volume has shifted. The Shanghai Gold Exchange is now seeing massive withdrawals of physical metal. This is the arbitrages of the century. Often, the price of gold and silver in Shanghai trades significantly higher than the price in New York. We call this the Shanghai premium. What does this do? It acts like a vacuum cleaner. It sucks physical bars out of Western vaults and ships them east. The metal leaves London, it leaves Switzerland, it lands in China, it lands in India, it lands in the reserves of the BRICS nations. Why are they doing this? Because they know the dollar is being weaponized. After the sanctions on Russia, where the US government seized $300 billion of sovereign reserves with a keystroke, every central bank outside of the G7 realized that their dollar reserves were not safe. If you hold dollars, you hold a liability of the United States government. If you hold gold, you hold an asset that no one can freeze, no one can sanction, and no one can print. The Hunt brothers failed because they used leverage. They borrowed money to buy silver. When the margin requirements were raised, they were forced to sell. China does not need leverage. Russia does not need margin. They are buying with trade surpluses. They are exchanging manufactured goods and energy for physical metal. You cannot margin call a nation that pays in cash and takes physical delivery. This is the structural break. The West is trying to suppress the price with paper derivatives to maintain confidence in the fiat currency system. The East is using that suppressed price to drain the West of its remaining physical inventory. It is a wealth transfer of epic proportions, happening in slow motion, right in front of our eyes. The vaults at the COMEX are bleeding silver. The eligible category, which is metal sitting in the vault but not warranted for delivery, has dropped. The registered category, the metal that is actually available to be bought and delivered, is hovering near historic lows. We are approaching a point where the paper claims on silver will exceed the physical bars available by a ratio that is mathematically impossible to reconcile. In 1980, they changed the rules to save the banks. In 2011, they smashed the price with naked shorts. But in 2026, who are they going to smash? You cannot force the People's Bank of China to liquidate their gold. You cannot force the Indian housewife to sell her silver jewelry. The mechanism of control is breaking. The psychological dominance of the dollar is fading. And when the physical shortage becomes undeniable, the price will not just rise, it will reset. We are looking at a revaluation of real assets against a crumbling ledger of debt. The history books will record this as the moment the baton was passed. The only question is, which side of the transaction are you on? Are you holding the paper promise of a bankrupt empire? Or are you holding the metal that has outlived every currency collapse in the last 5,000 years? Now, we strip away the financial engineering and look at the physical reality. Forget the charts. Forget the leverage. Let us talk about the metal itself. Silver is not just a monetary metal. It is the most conductive element on the periodic table. It is indispensable to modern civilization. You cannot build a solar panel without silver paste. You cannot build an electric vehicle without silver contacts. You cannot guide a Tomahawk cruise missile without silver in the guidance system. And you certainly cannot run the servers that power artificial intelligence without silver interconnects. This is the collision course. The demand for silver is exploding, driven by the green energy transition and the digital revolution. The Silver Institute reports that industrial demand has hit record highs. Solar alone is consuming nearly 200 million ounces per year. That is roughly 20% of the entire global supply, vanishing into panels that will not be recycled for 20 years. Electric vehicles use up to twice as much silver as internal combustion engines. With mandates banning gas cars in Europe and California by 2035, the auto industry is scrambling to secure supply. They are bypassing the COMEX. They are going directly to the miners. They are signing off-take agreements to buy the metal before it even leaves the ground. Why does this matter? Because the COMEX, the exchange that sets the price, is being drained. The registered inventory, the silver that is available to settle futures contracts, has fallen to levels we have not seen in decades. At one point, there were over 150 million ounces in the registered category. Today, that number has collapsed. We are looking at a market that is running on fumes. Let us look at the premiums. When you go to buy a physical silver eagle from the US Mint, you pay a massive markup over the spot price. Why? If the price of silver is $25 on the screen, why does it cost $35 to hold it in your hand? The answer is backwardation. The spot price is a lie. It is the price of a paper contract, not the price of the metal. The real price is what you pay to get delivery, and the dealers know it. The refiners know it. They are charging premiums because they know the metal is scarce. They are struggling to source 1,000-ounce bars. The mints are on allocation. This means they are rationing supply to their distributors. And now, we have a new player, artificial intelligence. AI chips require massive amounts of power and cooling, but they also require high-performance connectors. Silver is the only material that can handle the thermal and electrical loads without degrading. As data centers expand to support the AI boom, the demand for silver in electronics is projected to surge. We are facing a structural deficit. For the last 3 years, the world has consumed more silver than it has mined. The deficit in 2022 was nearly 240 million ounces. That is the largest deficit on record. Where did that silver come from? It came from above-ground stockpiles. It came from the vaults in London and New York. But those stockpiles are finite. You cannot print silver. It takes 10 years to permit and build a new mine. And the grade of silver in existing mines is falling. We are digging up more rock to get less metal. The easy silver is gone. So, we have rising demand from strategic industries that are price inelastic. Do you think Apple cares if silver goes to $50? No. There is a fraction of an ounce in an iPhone. They will pay whatever it costs to keep the production line moving. But for the investor who is short silver, that price move is fatal. The industrial users are draining the physical market. The investors are waking up to the inflation threat, and the vaults are empty. This is the perfect storm. It is a mathematical impossibility for the price to remain suppressed when the physical inventory hits zero. When the last bar leaves the COMEX, the game of musical chairs ends. And there are millions of paper claims for every single ounce of physical metal remaining. When the music stops, the holders of paper silver will get a check for the cash value of the contract at the moment of default. They will get their fiat currency back, but they will not get the metal. The only people who will own silver are the ones who hold it, the industries that need it to survive, and the individuals who saw this coming and took delivery. This is not speculation. This is supply and demand in its rawest form. The industrial complex is hungry. The green agenda is hungry. The war machine is hungry. And the table is empty. Look at the data from the bullion dealers. They are reporting delays. They are reporting shortages of specific products. The sovereign mints are canceling production runs. The U.S. Mint has admitted they cannot get enough silver blanks to meet demand. This is the reality on the ground. While the talking heads on television discuss interest rates and soft landings, the physical foundation of the global economy is being quietly cornered. The squeeze is not coming. It is already here. It is just being masked by the paper derivatives market. But you cannot build a missile with a paper contract. You cannot build a solar panel with a digital token. Eventually, reality wins. Now, let us strip away the financial noise and look at the periodic table. This is where the paper market collides with the laws of physics. Silver is not just a trading vehicle. It is the most conductive metal on Earth. It is non-negotiable for the modern world. You cannot build a solar panel without silver paste. You cannot build an electric vehicle without silver contacts. You cannot guide a Tomahawk cruise missile or run a ballistic defense system without high-purity silver in the circuitry. And you certainly cannot power the servers that run artificial intelligence without silver interconnects to manage the heat and data flow. We are staring at a structural deficit that the market is refusing to price in. According to the Silver Institute, the global demand for silver has outpaced supply for 3 consecutive years. In 2022 alone, the deficit was nearly 240 million ounces. That is the largest deficit on record. Where did that metal come from? It came from above-ground stockpiles. It came from the vaults in London and New York. But those stockpiles are finite. You cannot print silver. It takes 10 years to permit and build a new mine, and the grade of silver in existing mines is falling. We are digging up more rock to get less metal. This scarcity is already showing up on the street level. Go to your local bullion dealer, try to buy a monster box of silver eagles. You will see something that defies the spot price on your screen. The spot price might say $25, but the dealer will ask for $35 or $40. This is called the premium, but in reality, it is the true price of physical metal. The paper price on the COMEX is a fiction, created by high-frequency trading algorithms and leverage. The physical price is the reality of a draining inventory. The U.S. Mint has admitted they cannot get enough silver blanks to meet demand. Dealers are on allocation. The supply chain is snapping. The industrial users, the tech companies, the defense contractors, they are not price sensitive. Apple does not care if silver goes to $50 an ounce. There is only a fraction of an ounce in an iPhone, but without it, the phone does not work. They will pay whatever it costs. This is the floor under the price. While the hedge funds play games with paper contracts, the vaults are being emptied by entities that intend to use the metal, not trade it. When the registered inventory at the COMEX hits zero, the game of musical chairs ends. And right now, there are hundreds of paper claims for every single ounce of physical silver left in the vault. We are approaching the endgame. Scenario A. The paper price finally breaks, sending silver into a vertical ascent to triple digits. Scenario B. The exchanges change the rules, forcing cash settlements while the physical metal disappears into private vaults forever. In either case, if you do not hold it, you do not own it. Do not trust the screen, trust the weight in your hand. For the full dossier on the mining stocks we are tracking and the specific buy zones, click the link in the description below. Get the map before the territory changes. Stay safe.